Want to know exactly how the smartest investors are underwriting deals in 2025? It's not just about rent growth anymore. It's about controlling downside, unlocking hidden upside, and using the capital stack like a weapon. Today I'm going to walk you through what institutional playbook looks like, line by line. The underwriting game has changed. What worked in 2020 doesn't work now. Interest rates are volatile, rent growth is uneven, and insurance costs are spiking. And yet, institutions are still making aggressive acquisitions. Why? Because they've shifted how they underwrite risk. They stopped looking for perfect deals and started building perfect structures. Most investors are playing checkers. They're still looking for 5 caps and 8% cash on cash. But the institutions, they're building 10-year risk-adjusted strategies that absorb shocks and scale returns. This shift isn't just analytical, it's philosophical. They no longer assume appreciation, they manufacture it. Where smaller investors react to interest rate headlines, institutions are 3 quarters ahead, hedging before the storm hits. They bake in policy risk, regulatory headlines, and demographic changes. Even their renovation plans are modeled against 3 potential GDP scenarios. They assume pain and build for durability. This is why they win. They don't wait for the market to stabilize. They stabilize the market by buying before it does. And while retail investors chase yesterday's headlines, the institutions are monetizing tomorrow's outcomes. Because in this business, it's not just about owning assets, it's about owning the narrative. They control perception by controlling data, they move before clarity appears, and when the dust settles, they're already 2 turns ahead on the chessboard. Smaller investors wait for the green light, institutions drive through yellow. The delta between perception and preparation is profit, so you either make the market or chase it. One builds wealth, the other buys late. This is where underwriting power becomes power, where structural becomes a signal and a strategy becomes a brand. So let's start with the base layer. Institutional buyers in 2025 are using regional banks for fixed rate, 5 3/4, 6 1/4, and 5-year returns, non-recourse agency debt on stabilized deals, 50 to 60 LTV, bridge debt only when paired with clear business plans and strong operators. But the real move, assumable loans. They're acquiring assets with 3.5 to 4.5 existing debt and layering fresh equity to avoid market rate loan entirety. Debt isn't about leverage anymore. It's about optionality. They're modeling minimum DSCR of 1.25, interest rate caps or swaps for variable rate loans, refinance exit by year 3, sell by year 5. Next, preferred equity. This is the silent power move in capital stack. Institutions are sourcing 8 to 10% preferred returns from family offices, private debt funds, institutional LPs with downside protection needs. Structure, 20 to 30% of the total capital stack, current pay plus accrued interest, senior to common equity, but junior to debt. Preferred equity smooths volatility. It allows them to reduce their common equity raise, preserve upside, and attract co-investors who want safety and yield. But most small investors skip this step. That's why they miss scale. Now, common equity. This is where the true profit lies. See, institutions are partnering with REITs, sovereign wealth funds, high net worth, co-GP syndications. But it's not just about equity, it's about tax optimization. Here's a formula. Cost segregation studies in year 1, bonus depreciation is shield income, refinance proceeds is return of capital, which is not taxable income, opportunity zone or 1031 exchanges on exit. Their IRRs aren't just built on rent growth, they're built on structural efficiency. Every dollar invested is maximized for tax and time. So let's talk operations. Every institutional deal follows a phase renovation plan. Phase 1, months 1 through 6, light upgrades of 20% of units, replace flooring, counters and hardware, smart locks, and AI-powered leasing. Phase 2, months 7 to 12, amenities overhaul, clubhouses, co-working, pet features, install package lockers and efficiency HVAC, and raise in-place rents 8 to 10%. Phase 3, months 13 to 18, complete renovations and remaining units, push rents to market, and refi at new NOI or begin sale preparation. By month 18, they've increased NOI by 20 to 35%. Now, let's talk risk modeling. Institutional underwriters assume vacancy at 8 to 10%, concessions during lease-up, rent growth capped at 2 to 3% annually. But they're also building downside scenarios. What happens if rents drop 5%? What if insurance jumps again? What if cap rates decompress by 100 basis points? Every scenario is stress tested, and they're not surprised by volatility, they expect it. The difference? They're prepared to act when others are paralyzed. Because data wins, period. Institutions are underwriting with dynamic pricing algorithms, think RealPage and Yardi, predictive maintenance models, utility expense mapping by submarket, and They're buying deals before they hit the market because they've already modeled operators' weaknesses, deferred maintenance, leasing slowdowns, high staff turnover. They use that to drive down pricing before the offer memorandum is even built. Because small buyers wait for deals, institutions create them. So here's how you use this. If you're an owner, audit your debt, what's coming due. Evaluate renovation ROI by unit type. Get your books in order now, not during the LOI. If you're a broker, bring pre-modeled deals to your buyers. Focus on debt assumptions and hidden NOI gains. Know how to speak to preferred equity and tax strategy. If you're a buyer, stop underwriting to perfection. Stress test for reality. Build relationships with lenders offering assumable debt. Institutions aren't always smarter, they're just structured. See, this is the new game. Not just what you buy, but how you structure it. Not just cap rates, but capital stacks. The investors winning in 2025 aren't guessing, they're engineering. And in the next video, I'll break down the exact submarkets institutional buyers are targeting right now, where dry powder is moving, which metros are seeing the most debt assumptions, and how to align with the smart money before it's priced in. Because the game is won before it's played, and let me show you why.